Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Weekly for Saturday, May 16th, 2020. And our top story today, coronavirus student loan debt forgiveness. And joining me now to discuss this and a lot more is Betsy Mayotte. She is the founder and president of the Institute for Student Loan Advisors. Betsy, welcome back to the program.
Hi there.
It's great to see you. And first, before we begin, how are things going up in the Boston, Massachusetts area?
Well, it's going. I think like everywhere else, people are starting to go a little stir crazy, but the weather is finally getting nice. So at least we can get outside at a safe distance and get some fresh air, which is nice.
Yeah, that's certainly, I think it kind of refreshes and reinvigorates people. So let's jump right in. I mean, when we last chatted, and we chatted a couple weeks ago on the podcast, BRN Sunday podcast, we talked about some of the COVID-19 responses for student loans, and that was some, delaying of, I think, payments towards, federal granted loans, et cetera. But what's the latest news as you see it, and the Institute sees it in terms of student loans?
Yeah. So, I think last time we spoke, the student loan servicers were just sort of getting those waivers in place. And now that we're a couple weeks in, what I'm hearing from borrowers and what I'm seeing is that for the people with federal student loans that are eligible for these waivers, they're all pretty much in place. What I'm running into now is the 25% of federal student loan borrowers that aren't eligible for the waivers, and they're just sort of starting to realize it. So we're working with those people to tell them what their options are. I know there's a lot of organizations out there that have been approaching Congress to get them to encompass this other sort of lost 25% because they need the relief just as much as everyone else does. Mm-hmm. I'm also talking to a lot of borrowers who have private student loans. Now, private student loans, for the most part, don't have as many options available to them. They certainly aren't eligible for the CARES Act waivers. Yeah. So we've been trying to work with borrowers to find out and help them figure out what type of relief they might be able to get from their lenders if they're struggling.
Yeah, and we're almost 8 weeks into this pandemic as we're recording this. A lot of people are, we have 30 million people that are unemployed. A lot of people are financially strapped because they may be furloughed. They may not have access to capital. They're just trying to put food on the table. Is it your sense, and we already had $1.5 trillion, I think the number was, you correct me if I'm wrong, in student loan debt before this. Do you see this, even with the relief, do you still see this thing kind of snowballing and continue to grow? Or do you think that this will give the opportunity to kind of continue to pay down that student loan debt over time?
I think there's a couple things going on. I've talked to a lot of borrowers that have gotten the 0% interest and the 6-month waiver, and they have not been financially impacted by the pandemic at this point. So a lot of them, I'm encouraging them to build up their emergency funds first because we don't know what the long-term economic impact of this pandemic is going to be. Mm-hmm. But a lot of them, after they've built up that emergency fund, do plan on paying down their student loans at the 0% rate as much as they can. But for those that are impacted, even the ones that have gotten the waivers, they're already starting to worry about what's going to happen after September 30th. Because again, we anticipate the economic impact of this pandemic to go on for some time. So thankfully, some of these borrowers are already trying to plan ahead and figure out what their strategy should be once the waivers have been lifted.
Well, let's talk about kids. They're all kids to me. The kids that are graduating from high school, they're going to college. How could all this change colleges and universities? The costs by some accounts are very high for some of these tuitions, and that has impacted a lot of the student loan debt. But do you see this pandemic having an impact maybe on future student loan borrowing and also future tuitions?
I do. So what we're seeing now is a lot of families sort of rethinking their college choice. They're not necessarily comfortable. Maybe originally the student had chosen a school where they would have left the state and lived on campus. We don't even know if the schools are going to be reopening for on-campus learning come the fall. But regardless of whether they do, there's a lot of families that aren't super comfortable with the idea of the student living off campus. So they're rethinking their decision, and maybe considering changing schools to one closer to home where they can actually live at home. The other side of it is the families where one or both of the parents in the household have lost their jobs, have been furloughed, or their hours have been reduced. So what they could have afforded for college 6 months ago is not what they potentially are going to be able to afford for college now. So they're considering maybe taking a step back and considering having the student attend a lower price school until they sort of see how this all shakes out. The schools are economically concerned as well, especially schools that rely on international students for
Yeah.
a big part of their tuition. A lot of those international students are not going to come this fall. So we're seeing schools extend their deadlines. I haven't seen any adjust their cost at this point, but I think if the economic impact for a number of years, I do see it affecting the cost of tuition and therefore borrowing.
Yeah, and I have to think that obviously there's the value that you put on this as a student, as a parent. It's the college experience. I mean, I remember a long time ago going to college and interacting with my peers and doing the social aspects as well as the academic aspects of it. Now, a lot of colleges have put the the distance learning into place, and maybe that will be the case in the fall. Again, we don't know what all this is. I'm sure that there are colleges and universities, but that could actually, Betsy, dampen the value, right? So you're paying X number of dollars of tuition, but are you really getting the same value that you would have gotten if you were on campus, even if you were not staying on campus?
That is something to consider. Now, as someone who has experienced both the on-campus college experience as well as distance learning, I got my graduate certificate via distance learning through Northeastern. And I think it depends what type of learner you are, whether you're going to get a robust education from distance learning. Distance learning isn't easy. I would argue that you actually put more hours into a class if you're doing distance learning versus on campus in some cases. So part of it depends on the person too.
Yeah, I think you're right. I mean, we all are different types of learners. Some are auditory, some are visual, some have to actually do it, like myself. Betsy, in terms of looking at Fannie and Freddie, how have they adapted? I mean, we talked about the CARES Act and the stimulus plans in terms of supporting people who have these student loans. But have they adapted in terms of future payouts? Are they being more conservative in terms of who they will allow to borrow? Are there changes there?
So I assume you're talking about the private lenders, the Sallie Mae's of the world and the SoFis. Fannie and Freddie are on the mortgage side.
I'm sorry, I said Fannie and Freddie, but I meant, I have mortgage on the brains. My apologies. I know you meant, I'm sorry, I meant Sallie and Sallie Mae. I'm sorry.
No worries. I just wanted to make sure we were on the same page. So in regards to what the private student loan lenders are doing, whether it be Sallie Mae or SoFi or Earnest, I'm actually hearing from borrowers that they're seeing that the interest rates are actually going up, which was a surprise to me considering what's going on with the economy. I think, when you're looking at, especially at student loan refinancing, they're not just looking at your credit score. They're certainly looking at it, but it's not just your credit score. It's not just your debt to income. Private student loan refinances are looking at whether or not you graduated college, what college you went to, what your job prospects are. And because of what's going on in the pandemic, especially those last three things, all could really change dramatically. So the risk, I think from their point of view, the risk has gone up a bit. So I think that's why we're seeing, at least right now, a blip of higher interest rates rather than lower interest rates. I do think if the college experience ends up changing for a longer period of time, we'll also see those private lenders maybe tighten up their credit criteria and maybe require cosigners even more strongly for new private student loans. So I do think that they are watching the market very, very closely.
Yeah, I think this is an ever evolving situation like it is in so many different industries. And I guess we're going to have to just continue to check in with you to see how things adapt. Betsy, always a pleasure chatting with you. Stay safe, and we will talk to you again, of course, very soon, right here on BRN.
Thank you.
Thanks, Betsy. Great to see you. Stay safe. And when we come back, we'll take a look at our best segments for the week, right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. On Wednesday, I sat down with Cerulli Associates' Anastasia Krimkowski to discuss how employers and U.S. record keepers are adapting to the pandemic. Let's take a look.
Where there's a lot of financial anxiety right now, there's a lot of economic uncertainty. And from a retirement perspective, we're always concerned that what's going to happen is people panic or they end up depleting their long-term savings to meet their short-term needs. And how do we get out in front of that and how do we help people manage that? I think the cautiously optimistic news based on what we've seen so far in the first quarter is that so far, for the most part, retirement investors are not panicking. Even if there was an increase in activity in the form of call volumes and communications, or even an uptick in the number of trades, as a percentage of total 401k participants, most people are not taking action. They're holding steady. They're seeking advice and they're seeking guidance, but they're not necessarily making drastic changes. I think one other thing that will be important to keep a lookout, though, and that we'll monitor throughout the year is what are distributions from retirement accounts going to look like, especially with the CARES Act and things like coronavirus-related distributions, increased loan limits. Will people feel the need to draw down from their retirement accounts to cover short-term expenses? Again, from first quarter activity, I would say that our viewpoint is we are cautiously optimistic that people are finding other ways to manage right now without drawing down from retirement saving. One thing was Cerulli partnered with the Spark Institute and DECIA to do a so-called pulse survey early in April that was directed towards retirement providers, including many record keepers. And then there are some large record keepers that publish their own data. Vanguard, Fidelity, Empower, Alight are the ones that come to mind, where they've been pretty open with what's going on in these accounts, and they're a great source of information as well. And I think we were already seeing employers and financial wellness providers, even before this current crisis, put more emphasis on the short-term financial obligations that participants have and on immediate solvency. So more emphasis on things like emergency savings or the use of health savings accounts to make sure that you have enough to meet a deductible if you have a medical emergency of some kind. So I think this was already an area of growing focus. Now these financial wellness resources are getting more use than ever for those who have a program like this in place. And I think this is only going to accelerate that focus on short-term solvency, not just the long-term planning goals like, retirement or funding a child's education, something like that. I think it's also part of the growing shift in our industry from just offering investment advice and offering more kind of goals-based planning. And that's where there's a real differentiator that, maybe anyone can go out and pick a cheap target date fund or something, but what they really need is help managing things like, budgeting and, again, meeting some short-term obligations and then setting long-term goals. And then the other thing I want to mention, too, in the context of financial wellness is that it's really hard to have a conversation about financial health separate from physical health. These concepts are really intertwined, and the best financial wellness programs are also going to understand the employer's benefits, including healthcare, understanding how that pairs with retirement and other benefits to help navigate employees through that. And this might be a weird, it might sound weird in the context of, like you say, a lot of people being laid off and facing other hardships. At the same time, for those who still have a job and might even be getting hazard pay depending on the nature of their job, they have a unique opportunity to get a little bit ahead. And the personal savings rate right now, I think as of March, was the highest it's been since the 80s. So people are saving more. Maybe they have their student loan payments right now in deferment. On top of that, they could be getting a stimulus check, maybe hazard pay. So even though a lot of the messaging right now is focused on the negative, which there is a lot of negative out there, it's also an opportunity to consult with those who can use this to either pay down that debt or boost that emergency savings or try to get a little bit of a leg up.
And on Thursday, I sat down with Matthew Carey. He's the co-founder of Blueprint Income to talk about their new partnership with AARP in developing an annuity exchange and marketplace. Let's take a look.
We started the business basically as a modern way to buy yourself a pension. So if your employer is not going to provide one anymore, you should buy one for yourself if it makes sense for your financial situation. But the annuity was the way to do that that we saw in the market. But the way it was sold was, we thought, somewhat antiquated. A lot of face-to-face, mostly large purchase sizes, so only a certain segment of the population had exposure to the information. And we felt like with better technology, we could make it accessible to everyone. And that was really the genesis of the business. So I left the Treasury, went to the Wharton School at the University of Pennsylvania, kind of as a way to meet co-founders. My wife was going to school at the same time, and I said, I'll go, but I really want to be focused on starting this business. And I met two co-founders and dropped out of the program and started the business from there. Typical startup, we worked out of an apartment at the very beginning in 2014, and then moved to New York in 2015, grew the team, added some actuaries, software engineers, and really now the business is focused on continuing to build out new kinds of experiences for our customers. So new kinds of ways to access the simplest kind of annuity products that are available in the market. We work now with about 30 insurers, and we have access to their fixed rate products and their fixed income products. And a big focus for us is just building out the software so that people can quickly compare across insurers if they want to change a feature, what that looks like, sort of taking the pain and some of the cumbersome things out of the process. It's good for the market writ large. We have a lot of people who come to us, and as much as we wish they didn't, they come, compare prices, and then like the assurance of finding a local advisor. And I think that's generally good for the market. We're sort of targeting a different segment. So both kind of that segment that's looking to purchase less and buy it over time. So think about, a lot of e-commerce companies, it's a subscription rather than a one-time purchase. And so we do that through a product called the personal pension. And then also people who just tend to be more DIY. So people who might have access to a financial advisor based on their level of wealth, but they just tend to want to do it on their own. And we've really found a niche there that it's growing pretty significantly. And I think as sort of the population that turns 65 continues to become more and more savvy with technology and using more digital tools to buy things like Medicare supplement, you alluded to the Affordable Care Act, Obamacare exchange, those sorts of things, I think are all kind of like part of a broader trend, which is everybody wants more transparent information, and some execute the sale through us, some execute it elsewhere. But I think that definitely kind of where we are is, I think, where the market is headed, and I think an important piece of the puzzle. We're extremely excited about the launch of the AARP annuity marketplace powered by Blueprint Income. We are now able to access AARP's 38 million members. Wow. And that, I think we really feel like it's an important service that we're providing, that someone has choice from 7 different insurers, all rated A++ or A+. So these are household names like New York Life, Guardian Life, Principal, Pacific Life, and a few others. Mm-hmm. And I think, what we've seen is that people really just want information to start the process. And so we are really focused on building really useful content, objective content, talks about the pros and the cons, talks about how it fits into a broader portfolio, talks about really make sense, and really focus on sort of the simplest aspects of it. The thing that an annuity provides that nothing else does is guaranteed lifetime income stream. And so at the end of the day, that's really where we focus in thinking about the products that make most sense for individuals. I think it's a really interesting opportunity. The way I think about it is in the 1980s, when the 401k was just being crafted. I think most people don't know this. There was a great article in the Wall Street Journal, maybe 2017, 2018, about the unintended consequences of the 401k. But originally, the 401k was really just a way for executives who were high earners to put more money away on a tax-deferred basis. It wasn't meant to become this default system. But I think back to that time period when it was just coming about. I think the right answer in the long run for our retirement security would have been to create sort of a hybrid. So if employers want to get rid of their defined benefit plan, how about the employer match go through annuity products? So the employer gets rid of the liability on their balance sheet, but they're able to still provide that retirement income, which is the purpose of a retirement plan in the first place. So they know when they're providing that match, which is costly for the employer, they know that the employee is not going to go, rate it early and buy a boat or do something reckless with it, and maybe pay a penalty to the IRS. And so I think, long way of saying, I think it's a natural home for annuity products, and the fact that to date there really hasn't been much by way of annuity access inside of a 401k doesn't make a ton of sense. And so, we do think it's an exciting opportunity. As you know, the 401k market is not a simple one in terms of there's lots of players in the space, quite a bit of complexity, and it's sort of a different ballgame than offering a product on a retail basis. But we are excited about it. We do think that there's clear signals from Washington about how retirement plans are going to need to change and evolve for their participants. And so we're really excited about that. And I think things like not just better access to annuities and 401ks, but also things like the retirement income disclosure. So what we're talking about earlier, forcing everyone to see every year, here's what it looks like in terms of income that I'm going to get from my plan. It just gets people in that mindset that I think will open up a lot of opportunities down the road.
And that wraps up this episode of BRN Weekly, but we're not done for the week, because tomorrow I'll be joined by members of the media, academia, and financial services to analyze all the news in retirement markets, technology, personal finance on the BRN Sunday podcast. You're not going to want to miss it. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.